You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, and welcome to the Infinite Banking Mastery Podcast. I want to start off this episode talking briefly about the Great Depression. I know, sounds depressing, right? Back in the 1930s, during the Great Depression, an estimated 9,000 banks failed. Talk about a nightmare. There were several major run-on banks, and that caused some major catastrophe. It was in 1933 that the FDIC was created because of this. Okay, so let's not duplicate what happened in the 1930s. Due to everything being paid electronically these days, we are going to need to have cash at the bank, whether we like it or not. And so we shouldn't all go out and create more chaos by pulling our money out of the bank. Now, that being said, I will add that customers back then who had savings in life and annuity contracts did remain safe. In fact, life insurance companies that I work with continued to pay dividends through the Great Depression and through 2001 and 2008. Housing savings dollars with life insurance companies is something that people have been doing for over 100 years. Life insurance companies are true pillars of financial strength, a great place to house savings dollars. And at the same time that we are building our savings here, we are going to need to use banks to deposit our checks when we get paid, to pay our mortgage, and to pay all our bills. So yeah, if we could sidestep the banks completely and house all our money inside of products issued by the life insurance companies, yeah, the funds would be safer. However, it's not functionally possible for us to do this anyway. First of all, life insurance companies, they don't work like banks, in the sense that banks have tellers, and you can go and get cash instantly at the bank. Another thing is that you are unable to pay bills directly from your cash value account inside of your life insurance policy. You need to first move the funds out of the policy and into your bank account to then distribute the funds to wherever they need to go. And another thing I always tell my clients is that we don't want to treat the policy as though it were a regular savings account and be calling the company frequently, like every week or every month, to request funds. Because life insurance companies don't have bank tellers and so don't have the capacity to be distributing funds as frequently as banks do. And we don't want the life insurance company to feel that they need to hire more service reps in order to handle a higher request for transactions and distributions of funds, because we don't want the company to have to raise costs and fees to accommodate this need. Therefore, we want to make sure that when funds are requested, we have a plan for those funds and don't plan to make another request right away. Of course, there is no restriction, so you can request funds when needed, technically as often as necessary. We just want to discourage frequent requests from our clients so that we can keep fees where they are. Same goes with repaying the policy. It's best not to be mailing funds in all the time or calling in your repayments frequently, because that takes a person to go in, a service rep to handle those calls, go into your account or open your mail. It's best to set up an electronic funds transfer to the life company or go about repayment another way. There are a few ways to go about doing this. So I definitely believe it is a great idea for most to begin housing savings dollars inside of whole life policies rather than the bank. We will still need to use banks, but can begin transitioning our savings to something more stable. And by learning the infinite banking concept, you can turn this stable and safe savings vehicle to a real powerhouse of wealth accumulation. On another note, I'm often asked, how much should I save? And my answer is always the same: as much as you can, because you have no idea the things you will need in your retirement years, or how much medical coverage, or what medical services you will need and what they will cost you. Like, what if you were to need a hip replacement, or heart surgery, or maybe cancer treatment? All of these costs are astronomical, not to mention assisted living costs. Have you ever looked into that type of cost? It will blow your mind how expensive it can be if you end up needing a lot of care. There are different types of care you can end up needing. For example, assisted living or a higher level of care that's needed for dementia. This one can cost quite a bit. Home care, where nurses are coming over or other caregivers to give help. Any need for these types of care in retirement or before retirement can quickly decimate a retirement plan. And we just have no idea what will happen with our health, with inflation. There's just all sorts of things up in the air. Not to mention that I'm sure you would like to enjoy your retirement savings or your retirement by doing things you love. It's for all these reasons that we need to save as much as we possibly can. And since you very well may be living in retirement for almost as many years as you were working as an adult, yeah, you'll need a lot of money saved. And that's just another win for the infinite banking strategy because it allows you to save as much as you possibly can while allowing you access to all those funds as they are growing your entire life. This allows you the ability to challenge yourself to save more because those funds are not locked up. They are accessible on day one. Of course, there is some further detail around this and explaining to make sure you understand just how much is available on day one. But for those of you who have an understanding of what the term paid up additions means, those funds are fully accessible on day one, well, depending on the company and how much you're doing. I will break down the meaning of that term on next week's episode. These policies also do have flexibility if you were to be unable to maintain a premium in any given year. I almost always recommend that you save at the top of your budget because you can always go down in premium. Going down is easy, but you cannot increase your savings into that policy beyond what you started with. I'm going to go into this topic too in more detail at a future time. Why you can't save as much as you want or add as much as you want into your original policy, the reason why you can't just put any old amount into your existing policy every year. I will go into all of that in an episode coming soon. But back to my original point, that this is one of the things I love about the infinite banking concept is that I can save as much as I possibly can into my banking system, knowing I can go into these policies if needed to finance a necessary purchase or to invest in other assets because life insurance cash value is easily converted into cash. Now let's get into the topic of today, which is the idea of keeping your money in motion. Conventional wisdom that we've been hearing for years tells us to store up money, at least 10% of your income, pay yourself first. I'm sure you've all heard that before, as a big lump sum or more than one lump sum if you've had different jobs and accumulated piles of cash here and there from your different jobs or different 401ks. And then let's let the money sit there until you need it, in your retirement years. And in the meantime, while you're waiting for this money to grow, if it's in a type of retirement account, you are penalized to touch those funds, your own money. You are penalized to touch your own money and also penalized if you don't begin depleting that account at the rate that Uncle Sam tells you to once you reach a certain age. Then we are told that the people who are doing the best job are those who have amassed the largest piles of money and haven't touched it. But as the infinite banking concept points out, and others out there, this is not the only way to grow your wealth. But instead, you can grow your wealth by doing what other wealthy people are doing, by keeping it moving, rather than just letting your money sit. Robert Kiyosaki has some great books. Rich Dad, Poor Dad is a well-known book. My favorite book that he's written is called Second Chance. Robert Kiyosaki teaches what many people out there are doing, which is actually using money, using other people's money, and leveraging that money to create more cash flow. The infinite banking concept teaches you how to do this and how to recycle your own money as well, how to build up your cash value account, then borrow against it for paying off debts to outside banks or access the cash for other reason. But really the way to utilize this cash is to purchase investments that you are passionate about, investments you understand and want to take part in. For example, whole life and real estate really go hand in hand very well together, and many are discovering this little nugget. If you had a sizable savings built up in your whole life policy, let's just say it's 100,000. You could then borrow against that policy, borrow against the 100,000 to go out and put a down payment on a rental property. Now you've used the same 100,000 to fund a whole life policy and purchase a rental property. And all the while, your 100,000 within the life insurance policy continues to earn guaranteed interest and dividends as though you never touched the funds to buy a rental property. Remember that example on compounding interest? The penny example from last week? So your account is growing with compounding interest, growing like a snowball as the years go by, bigger and bigger, even though you borrowed that money to purchase the rental property. Always keep in mind that I'm talking about a properly designed policy with a mutual life insurance company that pays their policyholders dividends for owning contracts. Okay, so in this example that I just went over, you're keeping your money in motion by using the funds to purchase the rental and then replenishing the loan with rental payments from your new tenants. And you've created a second source of cash flow, the rental income. As a side note, I just want to clarify that taking a loan just for the sake of taking a loan and then just replenishing the loan, just only paying the loan back, isn't doing anything amazing on its own. This is not what I mean when I say to keep your money in motion. It's what you do with the funds and how you replenish your account that will make your system more amazing. You want to create loan repayments to yourself with interest for the loans you take each time. This is what will ultimately grow your system. As opposed to the conventional wisdom I mentioned earlier, with IBC, you are funding your accounts or your accounts to the best of your ability with a premium that fits your budget so that you can build as large of a pool of cash as possible, because the larger you build that pool of wealth, the more you're able to use that money to finance the needs and wants, the investments in your life. The larger this account, the more you can borrow against this account, leveraging other people's money, the insurance company's money, to purchase investments that will create cash flow for you. Because at the end of the day, cash flow is what we all desire, right? Not just a big lump sum of savings that we're afraid will be depleted. The larger your pool of cash inside of your banking system, the better off you will be for the needs all throughout your lifetime, things you're going to need to acquire or buy, and the better off you'll be in retirement. The financial gurus of the world have all been telling you to build a large pool of retirement savings in order to have a comfortable retirement. But isn't it a little messed up that you can't touch your money, your own money, without penalty for all but 13 and a half years of your life? Not being able to touch that money does make it harder to save at a very high rate, because you need money now too, for the things you need in life and the things you want to do. And isn't your true goal to really have as much cash coming in every month that you possibly can? Because once you do get to those retirement years, you will need to find a way to turn that lump sum of investments into an income stream, and preferably an income stream that you cannot outlive. You will need to start selling your assets, your investments, in order to do so. And if the market is in a volatile time period, this can be catastrophic to your portfolio. So what you and everyone else really needs is more cash flow, more money coming in every month. And if you have vehicles creating cash flow that's flowing into your bank account every month, that's really what the end game is. And by using the funds inside of your whole life policy to make these investment purchases or to pay off debts that you have and want to get rid of, and then creating a payment back to yourself like you would to any bank, that is what it means to keep your money in motion. Using the funds to finance the major purchases or investments you need or want, and then creating a loan repayment with interest to yourself, that's the key, with interest, is what's keeping your money moving and doing what banks do. Because aren't they loaning out your money just as fast as they receive it? Absolutely. Remember that when you deposit your money into your savings account at the bank, they are not just letting it sit there doing nothing. They are keeping it in motion by loaning it to others. and they are loaning it out as fast as they possibly can, times 10. We have all been told all our lives to save money, to grow a large amount for our retirement years, to not touch the money so that it can grow for those future years when we will need it, to accumulate wealth, to store it up in these big piles of cash, rather than what the wealthiest in our nation are doing, borrowing other people's money and keeping money moving. Because whenever money moves, there is a profit to be made, and banks have built their business model on this opportunity. So the banks are telling you to save your money and let it sit, while they are doing the exact opposite and immediately putting that money in motion. And the reason they want you to let your money sit is so that they can put your money in motion and make profits on it themselves. Because in order for them to have money to loan, they need you to let your money sit. So why not take these actions yourself? Again, the key is to pay yourself back with interest, either the same rate that you would have been charged to borrow the money from somewhere else or a higher amount. By doing this action, you are taking the similar actions that banks take with your deposit. This is keeping your money in motion. By paying yourself back with interest, you will end up replenishing all your money to your account and then some. You will end up with more. So you might grumble at the thought of having to charge yourself interest, but this is a discipline you will be thankful you created for yourself. Because at the end, you are the one who's going to end up with more money, rather than letting the bank profit off of your dollars. And you will end up with a larger banking system and more money for those retirement years. This process allows you to recycle your money and capture the earning power of all those dollars before they are deployed for other use. Use the funds for one purpose, pay them back, then use them again, over and over until you reach your retirement, and then use the funds one last time to help fund your retirement. And all the while you're using these funds all throughout your life, your account continues to grow. Because while you are taking these actions, since you leveraged your policy by borrowing the insurance company's money and using your policy as the collateral, your money is still there, left in the account, and continues to grow with compounding interest. I will get into this more in my next episode, but there is nothing on the face of the earth more powerful than taking these teachings and putting them into practice in your life. That's why the bankers are where they are, at the top. When I first learned of this strategy, I was like, wow, this is the most powerful strategy that I could ever help my clients implement, helping them to take over the banking function of their lives, because this is teaching you how to be in control of your financial environment, to control the financial equation in your life, and by using the guaranteed asset of whole life insurance. One of the most important things to note about this process that I can't stress enough is that in order to get a policy up and running for yourself, it really needs to be a properly designed dividend-paying whole life policy and with a mutual life insurance company. You should seek out an IBC practitioner like myself from the Nelson Nash Institute to make sure you are getting this properly designed policy. I'll talk more about this in a future episode about why you should seek out an IBC practitioner. Another important thing to note is that the infinite banking concept is just that. It's a concept, as is a process, not a product. The process of keeping your money moving and creating your own banking system. Yes, we are using a product and a very specific product, but that's not where it ends if you want your system to do and be all that it can be, and if you want to grow your system. Don't get me wrong, if you're not banking with your policy, whole life is still a fantastic place to house your savings. It's just that putting these teachings into action will create a much larger pool of wealth. Keeping your money in motion and leveraging other people's money is more of an entrepreneurial way to build your wealth. My next episode will be on the topic of borrowing against your policy. I will go into more detail on what that looks like and more of the mechanics of the policy. And if you just so happen to be in the season of your life where you have already worked hard at accumulating a large savings and are needing to find a way to live on your retirement savings, maybe you desire to turn that lump sum of savings or some portion of it into an income stream that you cannot outlive, This is also one of the ways that I help my clients, and so something that I can help you with too. If you are needing help with this or wanting to learn if you could implement the infinite banking concept in your life, please reach out to Valerie@alphaomegawealth.com. I'm going to leave you with a Thomas Jefferson quote today that he said about banks. The issuing power should be taken from banks and restored to the people, to whom it properly belongs. Wise words from a wise leader. Have a great week.
This is thepodcastfactory.com.